So we're continuing on this series of the 4 different payment options in the Florida Retirement System pension. Today we're up to option number 3. This is 100% joint. It covers you and a spouse. Now the benefits are, in the event that you're passing, your pension check would continue because it would be transferred to the spouse. So therefore, even if you were removed from the equation, your spouse would not suffer the loss of income because they would continue to receive the income from the pension. But what are the other sides of the coin? Well, the pension, option number 3, is the most reduced. And it's not a set number. It's based on a range. So if your spouse is a lot younger, it will be a heavier reduction. If they're older, not so much. But regardless, out of all the options, option 3 is the most reduced. Well, does that mean that if you're married or you have beneficiaries, that option 3 is automatically the best way to go? Well, not necessarily. You see, on these options, it's important to weigh the cost and the probability and the mortality rate. So oftentimes, some individuals have chosen to solve their beneficiary needs with a life insurance policy for several reasons. One is that their pension is taxable. So in the event that they were passing, that income they're receiving is still taxable, whereas a life policy is tax-free. 2 is that if their spouse passes away on a life insurance policy, they can just stop the payments and continue the high amount of, let's say, option number 1. But in option 3, if you chose that option and your spouse passes away, you've permanently reduced your check. It is going to be reduced, and you could be paying it for a long time and not have any of the benefits pay out to a beneficiary because your beneficiary passed away. Well, some ask, well, are children eligible for these options? Well, yes, but there's a few rules. The few rules is they would have to be under 25, and they would get the payout of option 1 up to age 25. At age 25, it would stop. Now, in the case of a disability, then yes, you could name a disabled individual as a beneficiary as long as that disability is in effect. So in most cases, when people are retiring, they're not going to have young ones living at home. But there is a provision made that in those circumstances where there's a disability or they have young ones living in home, they would be payable to those certain ages. So in review, option 3 is a lifetime payment for you and a spouse. If you're passing, it will be transferred to them. But it is the most reduced and it's selective. It can only be a spouse as a beneficiary in option number 3.